So hi all, I am Akshara Menon from PMS Bazaar, and it's an absolute pleasure to welcome you to today's exciting webinar on why commercial real estate is a smart choice in current market. Commercial real estate has always been a pillar of strength in investment portfolios, providing a stable inflation-adjusted returns. But now, with surging demand for office, industrial, and warehousing spaces, it's emerging as even more powerful engine for long-term growth. Today, we will explore how this dynamic asset class continues to offer the consistent returns despite the market fluctuations, and why it's becoming an increasingly attractive choice for investors in today's economy. We will dive into the strategic benefits of pre-released, fully completed properties with minimized construction approval and leasing risk, giving investors a stable, low-risk and entry into the commercial real estate. And of course, you will discover how this sector is well positioned for growth, backed by solid yields and increasing investor confidence. I'm honored to introduce our distinguished speaker, Mr. Rohit Rathi, with over 20 years of expertise in commercial real estate acquisitions. Mr. Rathi brings unparalleled insight to the table during his 15-year tenure in ICICI Bank. He worked with developer finance and real estate, handling business exceeding 1 lakh crore rupees. Let's dive into this insightful session. Over to you, sir.
Good evening, investors. It has been a pleasure. Thank you, Akshara, for such a grand introduction. It has been a great pleasure to do some webinar with you guys. Let me share my experience and details about real estate. So let me start by explaining how big is real estate. See, real estate is one of the oldest and biggest asset class in the world. All equities, all debt put together, real estate is much larger and much older asset class which is there in existence. If we see real estate as a large in India, largely there are two parts to the real estate sector. Say one is residential, another is commercial real estate. Let me just give what is currently happening in the sector and then move to the exact subject matter of commercial real estate, why it is a good choice at this point of time, which will make a better risk adjusted return for the investors. Say real estate has been a cyclical business. When we say cyclical business, it means there are down cycles, there are up cycles, and typically these cycles are long term cycles which take anything between 8 years to 10 years. So what is affected, how it is affected, the sector or the cycle is typically affected by two large factors. One is how the economy is doing, and second, how the capital markets have been performing. So this is specific to India. We have seen and we have correlated with both economy and capital market. Luckily for us, both economy and capital markets are doing very well. So what it has meant for real estate is it is also it has got its share of boost, and we have seen in last few years after COVID, the residential real estate, which is one larger part of the real estate sector, has immensely benefited from it. Just put numbers to it or perspective to it. In last 1 years, all developers put together has sold more than 6 lakh houses. More than 5 lakh crore rupees of flats have been, or the houses have been sold in last 1 year. What it means is, number one, the inventory levels in India has come down. That means it has come down to close to 12 months. If no new residential flats are made, then in next 12 months, entire inventory of India would be sold. So this is a number which is there, which we have never seen in history of real estate in India. What has got benefited out of it is most of the developers' balance sheet has strengthened further and given more boost to the sector. There are few other factors which also helped the residential sector. Say one was regulatory intervention in form of RERA, which give more confidence to investors to invest or buy under construction flats. And second, there was a lifestyle change and behavioral change which happened after COVID, where people were looking for good quality houses, for a inclusive houses where your work, your other requirements are close by to your houses, which has also benefited the residential sector. Now, let me come to the commercial side of it. Commercial real estate has also benefited in last few years. However, the benefit of that is not being able to be passed to the investors. Reason is, number one, commercial real estate doesn't work similar to residential. Number two, commercial real estate, the ticket sizes are much larger. And to understand it in detail, you need more detailed knowledge. Along with that, you require multi city knowledge, multi locality knowledges, so that you can get the best properties out of it. Let me give a small presentation and which will brief how the residential sector has emerged over past 10 years. What are the future things which we can see from it, and how somebody can get a better risk adjusted return from this asset class. So, just brief overview, as I said about residential, office grade A buildings in India will reach close to 1.2 billion square feet, which is 50% from the above levels of 812 million square feet. That means the new supply is coming and it is getting leased out also at a good rental. Why we feel commercial real estate we can get is a good time to invest? Number one, commercial real estate gives a regular rental income and a potential of appreciation also along with it. Second, today there is a lot of opportunity to buy these good quality assets at a very high yields. Third, COVID is behind us. The demand of leasing is back, and we can see that in numbers, not only just a hunch. In numbers, it has been proven that we have crossed pre-COVID levels. And last, when we are able to get a good risk adjusted returns with the completed properties which are leased out, the question is why to unnecessarily take approval, construction risk, or any other type of approval risks in the sector. With this, let me explain what is happening in office spaces. India has become office to the world. When we say this sentence, you would be surprised to know 55% of new global capability centers. See, the GCC is a word which you will commonly used. And earlier, a lot of MNC used to put their back offices, their other operations in India. Now, the new trend is they want their new research, development, and capabilities to develop outside their own country. And India has become one of the global centers. Today, 55% of new global centers which MNCs are putting are coming to India. The reason is twofold. First, India, the real estate is at a very cheaper price. We last 10 years back, we were still a dollar rental market. Today also we are close to a dollar rental. When I say dollar rental, it means our average rental is still between 80 rupees to 100 rupees square feet. We are at least 33% cheaper than other global markets. Second, we have a lot of English speaking crowd available. We have a lot of engineers and other science graduates which are English speaking. They are available at one tenth of global salaries. So for any MNC, it makes sense. Uh, the two large factor, your talent is available and this office space is available both at cheaper price, which makes cost competitiveness for Indian real estate. So this is one driver. Second driver, which is there, is local demand. Local demand is typically driven by how GDP perform and how the profits of corporates are doing it. So what we have seen after COVID is our GDP has also grown at healthy levels. Similarly, the profits of corporates, which are say in this graph, we have seen how NSC listed companies profits have increased. Because of increase in profits and because of increase in size of operations, they need larger offices. Hence the demand of office is back in India. Now let me give certain proof why we feel this is a correct time to enter into the sector and what has happened to the sector. See, for if you see B and C graphs, These graphs shows how the development has happened in India. See, India used to have 340 million square feet of grade A offices 10 years back. Today, we have doubled that space to 812 million square feet. And we feel there will be a further growth in next 6 to 7 years in this sector. This growth in the area, or the stock which has increased, this has increased along with the increase in rentals. Now what does it mean is ki, uh, it has not come at a cost of rental decrease, it has come with rental increase. So we have seen markets where the growth has been as high as 5.39% CAGR annualized rental growth. Some of the markets have been laggards, but on an average we have seen 4% as the annual average growth in the markets across country, uh, which is there. Now let's focus on D and E. Why this is a correct time to enter a commercial real estate? First point, as I said, COVID was a major setback to the real estate sector. Nobody was doing, whether people will work from home, there would be hybrid structure, there would be office structure. See, now 2 years down the line of COVID, now we can see there is a requirement of office. And by data, if you see last year, we were able to cross pre-COVID leasing activity. So 42 million square feet was leased as against 37 million before COVID. This year, we have seen in the first half year, we have seen highest ever leasing in India during this period. Uh, so that is another achievement which is there. See, E-graph shows how we are positioned in terms of interest rates. So let me explain how commercial real estate works. Commercial real estate works more like a bond. It we depend upon the income which is generated by the property or the office. The property price is determined based on the yield which is expected and the income which is generating. So today we are at a interest rate cycle at a high interest rates, say 8.5, 8.6 is MCLR of SBI. So today is the opportunity to buy properties at a high entry level yields. Similar to a bond, we are able to get properties at 8%, 8.5% entry yields. So how somebody can participate in this commercial real estate? There are typically somebody can directly buy an office and manage and maintain that property. That is one way. If you see institutional way of doing this, there are three larger ways. One is through listed REITs. There are four listed REITs in India which are doing the similar. They are managing the office spaces, and uh, they are low risk investment avenues. However, they earn between 2 to 11%. Then there is another option which is development funds. So there are a lot of funds which are doing development risks, which are taking development risks, where they invest in properties under construction, take approval risk, take construction risk, and eventually make money out of it. So that's another strategy which people play. What we are preferring to is strategy which is where properties are complete, leased out, and you take a specific bets on those concentrated bets on those good quality assets. There are funds which are doing this type of activity also, which are working more like a private REIT structures. The benefit is you can get returns which are much higher than the listed REITs offer today. So what are the key points in selection of the assets? See, we at ICICI have managed past two funds with similar structures. So our learnings we have put it on this slide. We have seen you can always look at properties which are good grade A buildings, which has very good tenants. And what are the things which help, which will give you better alpha returns than the other players? So we have listed it down also. See, some of the things which I just explained you. See, infrastructure is a very important element in commercial real estate. Any improvement in infrastructure or any benefit in infrastructure will improve the rentals and increase the price of the property. So example, say metro is coming to a place, or a new outer ring road is getting completed, or new railway line is adjoining the place, it improves this infrastructure significantly, which improve the rentals also. So example, let me give you. See, like there's a place in Bangalore called as White City, where the rentals have significantly increased from say 35 rupees square feet to 60 rupees square feet, because the metro connectivity changed the entire area. Similarly, we have seen areas in Mumbai, Chennai, where metros have significantly changed the or re-rated the areas. Another part of while looking at this type of properties is quality of tenants. Today, a tenant which sticks to a property, which invests in property, and which stays longer in the property, not only improves the value of property but also helps in maintaining and quality of the building. So today, a lot of buildings we know, oh, this building Apple is a tenant, or example Microsoft is a tenant. So once you have a good tenants in place, building names are actually changed based on the tenant's name, not even that. So example, we sit in a building called as one BKC, where Bank of America is a tenant. So you can see everybody knows ki Bank of America building is this. There are certain locations which are growth locations. So each city or each micro market in city, some of them offers a significant imp- uh, significant increase in the rentals because of the re-rating of the entire area. See, we have seen the example I will give you. We have seen areas like Nariman Point in Mumbai, which used to be a CBD earlier. Today, BKC have become the central business district, and people have moved from Nariman Point to BKC. Going for and the property prices in BKC has increased drastically. Similarly, at the property prices at Nariman Point has stabilized or not increased for so many years. So there's a time correction which happened in those areas. Tenant stickiness. How much tenant has invested in the property in terms of fit out, in terms of deposits, that makes lot of difference uh, in this commitment towards the property. And hence, we feel good tenants and good tenant with high stickiness are important drivers for this type of strategy. Let's see what are the areas we should avoid while acquiring the properties. One is any property which is under construction, or there are approval risks which are there in the properties. Properties where there are low quality tenants, for example, some of the startup, etc., which doesn't have a strong balance sheet for a long term stability. Probably you can avoid and get more better tenants than that. Buildings which have high vacancies, or buildings which have maintenance issues. We have seen certain buildings with high vacancy or uh, poor quality maintained buildings. This typically we have seen the rentals in those properties drop, and because of the reduction in rentals, typically the property prices also don't appreciate easily. See, another aspect about commercial property, let me just say, most of the people go with the gut feeling that was a property in my micro market and or my city, or I understand that city very well, hence I should invest in that city or that micro market. However, what we have seen is, see, there's a lot of change in the commercial real estate in terms of data availability, and you can make informed decisions based on the data. So let me give some example on this chart. We have put across 6 cities on this chart: Pune, Chennai, Bangalore, Hyderabad, Mumbai, and Mumbai and NCR. If you see, there are two large factors. One is rental, second is vacancy in those areas. We have seen an inverse relationship between rental increase and vacancy rates. So if more the vacancies, we have seen the rentals doesn't grow very fast, and in fact it stabilized over longer period of time, and hence the property prices also doesn't appreciate that much. So let's give an example. Pune or Chennai, where the vacancy rate was low, as less as 7%, or say example in 12%, that rental growth have been higher as compared to other markets. Similarly, if you see MMR or Chennai on the right hand side, the vacancies were always high. Now, see, this is a larger MMR includes everything. Other pockets, there are pockets in the MMR which have done much better than the some other pockets, but this is generalized data about the entire MMR. Because of the high vacancies, the rentals have not increased as significantly as it has happened in some of the other cities. So what affects is not only today's availability of supply, going forward next 3 year 5 years supply which will come in that same micro market. There are certain cities like Bangalore and Hyderabad, which has become a global, which has invited global MNCs to them because of the culture, because of the uh, because of the talent which is available in those cities. There we have seen, even with little higher vacancies, the rentals have gone significantly higher. We have seen these cities getting re-rated in terms of rentals in some of the micro markets, which has helped increase in the property prices in those cities also drastically. So a data-based approach which a professional can provide helps to get a better informed decision than how we can identify these type of properties. Let me give a example and what are the return expectation from this asset model at this point of time. So this today we are able to get properties which are completed, which is grade A building, which are completed, which are leased out at an entry yield of 8%. So what we are saying is, you start the property, you spend say 100 crores on the property. On day one, you are getting 8 crore as net rentals, which is similar to a bond. Along with this, there's a good tenant which is sitting who has signed a long-term contract. Example, in this case, example, most of the contracts are say 5 year plus. So 5 years, and there are typical rental escalations which are either 5% every year or 15% in 3 years. So what we are getting is, see, for a 5 year horizon, what we will get it, we'll get, we'll start with 8% rental. We'll keep on getting 5% escalation on the top of it. So 13% income growth, which we can see in 5 years easily annualized. Along with that, for this asset class, you can take leverage. Means since the rentals you are getting regularly, so banks are happy to give lease rental discounting product at a very competitive rates. See, today that is available sub 9% rate, and in a long term you are earning 13%. So you, there's a positive carry because you are taking leverage on. You need not to put your 100% equity to buy the asset. So the first quadrant, which is 14-15% annualized return, is what somebody can expect out of completed building, which is leased out and which is generating revenue from day one with the contract signed with the large tenant uh, on the day one. So 14 to 15% is a return which somebody can expect out of this strategy. Along with that, this is affected by interest rates in the market. Today we are at a high interest rate scenario. We feel in long term, medium to long term, the interest rate should come down. If the interest rate comes down, the yield uh, yield expectation also comes down, hence the property price increases. So there can be another 2 to 3% annual return which we can expect out of yield compression or increase in rentals beyond 5%, or reduction in the interest for the loan which you have taken. So all put together, this asset class can give a 15 to 18% return. Now, if you see overall return structure, the it's a very good risk adjusted return. Reason, let me tell you. One, you're not taking any construction approval risk. You are taking a building which is fully complete. You are taking a building which is fully leased out. You are controlling the building on your own, and along with that you are able to generate a return of 15 to 18%. So to summarize my explanation of this asset class, so today we at AMC feel asset allocation is a key for long-term wealth creation. Typically, people have equity, debt, commodities, and real estate in their portfolio. See, what we have seen is equity is a current flavor of the season, and most of the people are invested in equities. Debt as a product, because of its tax disadvantage, etc., uh, people are not preferring to put money in debt. This asset class, commercial real estate, can be uh, income plus strategy, where somebody can allocate certain portion of their debt component to this uh, asset class, which will help in diversifying the portfolio and getting a better quality portfolio for the investors. So with this, I will open for question and answers.
Thank you, sir. So yeah, that was thank you for the PPT. It was short and it was to the point. And there are few questions which was in my mind while you are presenting the PPT. So of course you are addressed about the post-COVID or post-pandemic and the racing the racing strategies for this particular asset class. But apart from hybrid workspace, there are something called co-working space as well. So
Absolutely.
that is also in growing demand. So and the whole property or the whole strategy relies on the tenants ka the rental yield when it comes to cost working space. So of course, how do you see that? How do investors want to see this?
See, after COVID, there has been drastic change in how commercial real estate has been treated. A co-working space has helped a lot of startups, lot of companies to save on the larger capital contribution you make towards setting up an office. Uh, we feel, see, there are two requirements right now. We can see one is domestic requirement, second is global requirement in form of GCCs. So most of the GCCs prefer their own offices in India, and they are not using part of the co-working spaces. However, a lot of startups in India are using co-working space. So our sense is both uh, co-working spaces and individual office will work together in tandem. Both are actually helping different segment of tenants to help their business requirements.
Okay. And one question, I'm just taking the last question first because the slide was on the tier one cities and their demand. So even tier two cities are finding, more space or more demand on this commercial real estate side. For example, Kochi or Coimbatore, for that matter.
Absolutely.
Apart from Chennai or Pune or Mumbai, which was taken in the PPT, how do you see the tier two cities got demand?
See, this is a new phenomenon which we have seen. Some of the large MNCs which used to concentrate in a larger cities like Bangalore, they based on their working employees and the nativity of their employees, some of the large MNCs, let me give you an example. Accenture has given 2 million square feet in Bangalore back, and they have taken smaller offices in Jaipur, Indore, Kochi, and some other places. Now, what has happened is they are not taken a millions of square feet; they have taken half a million square feet in these. But they are getting the local crowd there. So the whole idea how they are changing the strategies, they need local crowd close to their home after COVID to work there. They are more happy to work there, and not try to migrate people from all over India to, say, example, Bangalore or Hyderabad. So that will help these cities also. This will help the employees also, and this will help the tenants also in long term. So there are a lot of opportunities in tier two cities. Also, we see it. However, it will take some time to for these cities to develop a market which is good and healthy market for a long term investors.
Okay, thank you, sir. My next question will be on the comparing the commercial real estate side in India and as well as in global. So, when you compare, the biggest asset class is real estate, all over the world, and the so accessing the real time data becomes difficult when compared to developed markets and emerging markets. Like in US, you have economy and a lot of other apps where you could find a lot of data available, where comparatively in India, and investing in Indian properties, we don't find much data available. So how do you think the investor should approach the deal here?
So you're correct. Real estate is more. It's one of the sector which is less transparent than most of the other data. Today, if you see example, cars data or a motor data or a two-wheeler data, every month the companies and the association gives the data how much they have sold, how much they have manufactured, and etc. At real estate, it's more fragmented industry. Hence, the data is available in fragments. Second, it's a state-owned subject. So, what when state-owned subject means you all the policies, all the processes which have been laid by your state defines how the property would be managed, how the property would be dealt going forward. So that is also a state subject. So in India, we have multiple states. The good part is most of the governments, state and center, they have at least made uh, all the registrations public data. Registrations include not even sale of the assets, it includes the leasing of the assets. So we have seen certain startups in real estate also. They are mining the data from those agreements which are getting signed. Based on those, see, typically your agreement will have actually all the information. What is the area of building? What is the rent? What is the floor rate? Everything would be there. Now, if this is a public data and you have to compulsory register, so now what we need is some fintechs which are already working on it, which are aggregating that data and providing for a fee to investors to use the data and decide it. So when I was explaining data based approach for acquiring a property, uh, all these fintechs will help in long term to making a correct decisions.
Okay. So, but how do you expect this technology-driven thing, going forward in India? So, just that was the
So,
second part of the
the
question.
example I will tell you, today there are certain fintechs which has come up, which can give you real time data also, how many buildings are there, how much vacancy is there, how much rent is there in a specific building. Uh, Now it is on professional manager to interpret the data for 5 years, 6 years, 10 years, and make it which area will do better and which will not do better.
Got it.
So this will help you in decision making, and it will be added tool to the professional investment manager for making correct decisions.
So it will help the investment managers to make good decisions, like as investors. Thank you for that, sir. And my next question is that you were talking about the four quadrants, and the expected IRR was around 15 to 18%. And the very first quadrant was the rental yield, where it's supposed to was 7 to 8%, and this quadrant has the maximum number when compared to other quadrants. So
Absolutely.
when you say rental yields, and when you say it's a credit fund, and also the first thing comes into our mind is a defaulter. That's a biggest risk. What if the tenant default? So how does this how do you achieve this 15 to 18%?
Let me give you example how typically commercial real estate works is, number one, what is the tenor of the agreements? See, agreements are between 5 years to 9 years. If you do any agreement up to 5 year, it is called as leave and license agreement. If you do a 9 year, it is called as lease agreement. There are different stamp duties which are there, or both this. uh, if you see generalized rules which are there in India about commercial real estate, number one, there is a minimum lock-in which is there, which can be 2 years, 3 years, or 5 years. So, which stops the tenant from vacating, or you have to pay the full 5 year rentals if he's in lock in period. So, that is a big exit barrier for the tenant. Second, they give a deposits also. So, even if, example, let's say 3 years is the lock in period, they give a typically 6 to 12 months deposit to the landowners. So, and they have to give a notice also while vacating. So he will give at least a 6 months notice to vacate. So technically, you have a 6 months window where you can find a new tenant and replace the old tenant. So that is a and the important part which I explained, I wanted to put is how much tenant has spent in the property. That is a key element for him to stay. And how is his strategy, long term vision for India? See, example, MNC who wants to be big in India for a longer period of time, who's putting manufacturing facilities, who are putting research centers, they will not run out of the country easily. So if they are not going to run out easily, they will invest in the property. So I will give you one example. In one of our past assets, we purchased the asset for 9,200 rupees square feet, and the tenant was one of the MNCs. They spent 7,200 rupees square feet on fit out. So literally they have put huge money, and that was literally 5 years rent which they put it on uh, the property to make it world class property. So whether that type of tenant will go, the answer is no. Whether a person who's taken space in co-working space for 6 months can leave, answer is yes. So it's a very subjective approach. That's why you need professionals who can calculate, who can work out which is a good asset, which is not so good asset, or you can uh, take advice from some of the smart advisors.
Okay, thank you, sir. And when you talk about real estate, and there's residential real estate and commercial real estate, and the complexities in a residential real estate is much lesser when compared to this commercial part. So, how when an investor going to approach both, and what kind of factors that differentiate this?
So you are absolutely correct in putting people. Residential is all, almost all investors will have some exposure to residential real estate. Very few investors have taken benefit of this commercial real estate upswing which has happened in current scenario. Reason is twofold. See, residential, number one, in terms of ticket size, you can identify a property which suits to your capital allocation or capital availability for acquisition. So if I have 50 lakh rupees, I can technically buy a 2 BHK. If I have a 1 crore rupees, I can buy a 3 or 4 BHK. So I can actually adjust. So this is like buying to my size. It is fitting in. It's like a ring which can fit in my size. I can accordingly choose that ring. The loans to buy them is easily available. So banks are happy to give you a home loan at a very fine rates, and everybody is pushing boss, please buy a house. It's good for you. Whether this asset class is best suited for investor or not, the answer is reason is residential is more driven by consumption. Your yields, rental yields in residential is still 2 to 4% depending on market, but most of the India it is less than 2% rental yields. So nobody will buy the residential for yield purposes. They will buy residential for staying purposes or capital appreciation purpose. As compared to say commercial real estate, it has high rental yields, very close to the interest rate scenario in a country it typically works. So because of which the product is suited more to guys who wants a regular income as compared to only capital appreciation which is there in residential.
Okay.
So the asset class is available. However, the investor with different purposes or different goal will get the different asset class. What lot of investment managers like us are doing are we keep on innovating new products whereby we can bring this type of larger properties of commercial real estate available at a lower ticket size to fit to various investors requirement. Then you can compare probably a residential with a 1 crore ticket size in some of the funds which are doing commercial real estate, which can be compared. So you cannot compare a 100 crore commercial property with the residential 50 lakh flat. These are different animals together.
Got it, sir. And real estate has always been a sentiment back in India. It's always a sentiment. What makes it a sentiment because of the tangibility and the access and though the pride of owning it, which is not available when you take it in a digital form and that in a commercial space. So, how do you see the sentiment moving? Do you think the sentiment from the investors moving towards more towards this digital form of having in assets?
So we as Indians always like to touch, feel the asset, and be happy because this is my asset. This is a emotional question which is very big time attached to it. However, what we have seen is probably the best investment opportunity might not be in my city or the place where I stay. Today, India has become an open platform. Some of the other cities, say example, today I'm sitting in Mumbai. Probably there are better opportunities in Gurgaon or say Bangalore or say some of the other parts of the country. So that is a big differential. Whether as an individual I will move from Bombay and go to Bangalore and buy a asset, the answer is it has a lot of discomfort to get it. So to bring you your point, we love it to touch and feel. However, uh, a better investment opportunity can be outside our city, and it can be out of my ticket size requirement also. Hence, to get benefits of both ticket size and diversification across various cities, it is important to work with the fund probably which can give you both diversification as well as information into various other markets which are not the home markets.
Okay. Thank you, sir, for that. And let me talk on global institutional investors who are much keen on real estate and they want to
Absolutely.
invest in India now. So, and when these global institutional investors play the vital role in real estate investing in India. So, how does that and how does the approach they have differentiate from an investor or a fund manager uh, in taking quality deals?
The last 10 years of commercial real estate in India, it has been the most biggest beneficiaries have been the large global funds or the large sovereign funds. They have taken benefit out of that increase in the values in the assets. So it is very evident that they have got most benefited, and our domestic investors have actually missed that approach, which was available to us first. Now, let me tell you what these global players are trying to do. The global players doesn't want to take local nuisance or local nuances in development, etc., on their head. See, they understood that it's difficult to manage that. So what they did is they partnered with the local developers. Some of the large developers, some of the large funds have partnered. They developed properties along with them. Then they purchased the completed leased out property either to themselves or through REITs or through other fund structures. They have bought it. So that's how they are typically playing. uh, Second point is they are typically looking at a larger ticket size. A more than 500 million dollars is a typical deal size which these guys are looking forward. And in fact, a billion or $2 billion dollar deals also we have seen in past which these guys are interested. So they don't want to take smaller opportunity. They want to take larger. For them, the process is same. If they put small money or large money, so they are willing to put on the larger assets. What we see as a larger opportunity for the domestic player is all these mid segment properties which are between 100 to 500 crores, where the domestic capital, HNI's capital is not sufficient to go into that sector. At the same time, sovereign funds are not interested because of the smaller ticket size. But these are 100 to 100 crore assets which are good grade A buildings, which have good tenants, and which have a good visibility in terms of rental and growth.
Okay, sir. Thank you. And when you talk on the risk part side of this commercial real estate investing, apart from the credit risk, the one important risk will be the liquidity. Having a long, holding period for this particular asset class, and how should an investor approach the liquidity in it because it has a lock-in period also.
Absolutely. So how we see this? See, if you buy your own property also on your own, if you want to do the strategy on your own, any strategy which is linked to real estate or commercial real estate, it is typically long term. Say, example, if I want to buy a house or a office premises, I will pay all the stamp duty, etc. I have to hold for a 1 or 2 increase in the rental, then only I typically sell it. So my holding period is typically between 3 to 5 years if I personally try to do an asset purchase transaction. So you have to see from that perspective. So when a fund is also doing the similar strategy of buying an asset, the total investment horizon is between 3 to 5 years only. They will not be able to do less than that. What as a professional fund managers you can try to do is, rather than selling all assets and one go, you can time the assets on from, say, example, a fund is doing a 6 year fund, they can try to sell the asset from fourth year onwards and try to distribute the money. So probably for first 3 year there would be lesser liquidity, but as soon as the assets are getting resold, you typically get a large capital back. So rather than waiting for the last uh, month in the at the time of closure of the fund, you typically and start selling the assets at the end of third, fourth, fifth, sixth year and give regular liquidity to investors through the sale of assets.
Got it, sir. And this commercial real estate side, that where we 80% depend upon the tenants ka yield, and there's one even if it is a physical commercial place or it can be a digital commercial place, it is more like when tenants move out and when we don't get another tenant and the gap between how do you manage those things. And my second question followed by it is that sometimes in your one of your slide you just show the demand and supply when the supply would be there for the particular building but the demand might not be there, so how do you face this?
So let's divide your question into two parts. How you first is how see if a property is good property, has a good tenant, the chances of and has good neighborhood. So see example, a building has good uh, 10 floors and 5 floors are occupied by, say, Apple or some good tenants, then typically you will see all the other balance floors also getting leased out regularly. Based on the quality of building and grading of building, you typically get the leasing activity again and again. So let me explain you. I'm sitting in say example. Let's take example. I'm sitting in BKC, and our building is one of the best buildings. It's called as one BKC in Bombay. Uh, Now this building, if there is any vacancy in this building, there are 10 people who are waiting to take that area. Okay. Now there's a building which is next to our building, say 500 meters down the line, which is not that well maintained. It's not a grade A building. This, even if they are in the same micro market, they have vacancy. Okay. So what I was trying to explain is, if buildings which I was explaining, grade A, good buildings, and having good tenants, typically you have a good demand for that type of building. So it is based on demand of quality of that building, not the area. Second, if you have a good building, then it's good. Second, if you are able to purchase properties in those good building, the chances of getting releasing is also very fast. Okay, very fast means ki, like example in our building, which is one BKC, as soon as some of the person is showing interest that we will go out, 1 year in advance the area has been leased out, okay, with the anticipation. Now at the same time there are vacancies which are there. So what a professional manager will try to do is, number one, budget for those vacancies in the calculations of returns, etc., and while pricing the product or purchase of assets. Second is typically try to stay to the good buildings. Don't try to experiment too much with the new things, because in this strategy, since we are targeting stabilized, reasonable returns, we should not take too much risk. That is our guidance to most of the people. We should not take too large risk in commercial real estate in terms of trying to do new things. It's better to do old things, better to buy in the good building and good tenant, and don't try to experiment too much.
So it's just a follow-up question. In nowadays, even in residential real estate, when a person want to buy something, they expect all the amenities to be there in that particular
Absolutely.
building. So same likewise even in commercial real estate. So for example, the new thing which is coming up is the energy saving. Everyone who comes up saying that they have a solar energy at their place. So what are the new things that will come up, new investments or new innovations will come up in commercial real estate side?
So let me give you. You are absolutely correct. There are a lot of trend changes which happens. So one is of course the building. Second is new trends which are keep on coming. Uh, uh, See, first earlier it was good quality building. Then it was energy saving buildings, which are, so now they are called as LEED certified buildings. Earlier gold was a standard. Now most of the buildings which we look at are platinum certified. What that means by platinum is, it has all the energy saving efficiencies. It complies to ESG standards, and most of the new leases which are happening, or the MNCs which are trying to do, they are not only looking for green buildings, they are looking for green leases also. Leases means not only the building efficiency, the developer has ensured all the compliances to ESG standards at what would be the they will try to reduce the energy requirement going forward also. So there has been sea changes which keep on happening. Somebody has to be active in market, get those trends, and ensure your buildings are upgraded to the new standards. So you can always upgrade a building to at least get a better energy saving, etc., etc. So you should keep on trying to do and improve the quality of buildings.
Okay, sir. Thank you. And let me take one question from the audience is that, what percentage of one's wealth should be put in commercial real estate as a thumb rule as per your opinion?
See, my view is there should be asset allocation between equity and debt. It depends upon person's how risk taking capabilities he has to divide between equity and debt. A portion of debt technically has to move to commercial real estate asset class. It's part of, it's more like a debt fund. Hence a percentage of debt should go to it. So example, if my portfolio is say 100 rupees, I'm a high risk guy where I put 60% into equity, 30-40% into debt. At this point of time, with current tax structures in mind, I would be happy to put my own 20% into commercial real estate. But this is again each person's own choice, and it depends upon each person's risk taking
Got it. So that now that we spoke so much of deal sourcing and entry barrier about this commercial real estate space, now we need to shift upon the exit side of it. That's I think that's more crucial and that is more timing oriented. So
Absolutely.
how do you think an investor should approach it?
So if you see, exit is a big thing in the strategy to play. See, there are two things which somebody can do. One, somebody can be a REIT or a individual investors who perpetually own the asset. That means you will never sell it. You will get rental income regularly, and that's one way to invest. Second is any other AIFs which are there, which typically has a fixed life cycle, and hence at the end of life cycle they have to sell those assets. Now your question is towards those funds which has to sell the assets at the end of a specific tenor. Let me take you who are the typical buyers and what new things are happening in this sector. First, this sector has been unorganized, fragmented, and it has been owned by few investors only. What are the new things which are happening is this whole sector is getting institutionalized. When I'm saying institutionalized, let me put it, if you see global commercial real estate market, the biggest owners of commercial real estate in the world are insurance companies. Why insurance companies? They have treasury books. They need a long-term revenue generating, income generating products. They need to hedge against inflation, and hence they are typically inclined largely to put money into commercial real estate, which are rent generating. Another larger investors are say REITs, which are there globally, which also owns lot of commercial real estate. Let's see what is happening in India. In India, we already seen REIT regulations. There are four listed REITs which are currently available. Uh, Now there's the new guidelines which SEBI has come up with. They are called as small and medium REITs. Earlier REITs were promoted by sponsors, which are more like a developer. Hence, a developer was putting his own assets into the REITs and getting it listed. The new guidelines for the small and medium REIT which has come up, they are where any investment manager who is an independent guy can manage a commercial real estate property. Uh, they can offer units of that REIT to individuals or investors, and investor with even 10 lakh rupees can invest into those properties. So imagine every property in India, a good property, can be put on stock exchange. Any investor who has 10 lakh and above can put investment into that asset, and there will be a lot of participation of investors through this institutionalized framework. Now let me give you an answer how we plan to exit. Why I explain, see, we or most of the funds will be the feeders to this type of REITs which will happen. They would be feeders to the global funds who are looking for larger assets. So when you see an asset of 500 crore, it's a small. But you see a basket of 8 10 assets, it becomes 5,000 crore. It becomes a half $1 billion types. So it makes sense for them to acquire the entire properties together. Then insurance companies will become a big time buyers, and a lot of family offices and large offices are also consistently putting their money into commercial real estate.
Thank you, sir. So, with that, we've come to the end of the session. There are a lot of questions on the podium, more specific on the fund and the strategy. Probably this can be taken, offline. These questions, I'll be mailing these questions to you so that you will be answering each one of them, so that each question is
I'm
answered.
very happy. Our team can we can connect to our team. We have a strong team who can answer individually to all these investors who are interested, and we are happy to take one-on-one calls with those guys also.
Yeah. Thank you, sir. And that was a very brief PPT, and it was, and a new asset class. And I mean, it's a new asset class, but it was new to approach this commercial part of real estate. Thank you, sir.
Thank you.